Investors are eagerly awaiting the vote on Elon Musk's CEO pay package set for June 13th. Shareholders will decide if the Tesla chief can keep his record $56 billion compensation package that was awarded to him back in 2018. Yahoo Finance's Alexis Keene has been looking into the recent trends in so-called say-on-pay votes. Alexis.
Yeah, so there's some mixed support coming out from major shareholders in Tesla. You had last week Barron Capital's Ron Barron saying, vote yes, let him have this money. They have about 0.5% stake in the company. Then on the other hand, you had over this weekend Norway's Sovereign Wealth Fund coming out, a 1% stakeholder approximately, saying, no, we don't support this. But look, at the bottom line is this will come down to asset managers like BlackRock and Vanguard that tend to support management in these initiatives and have a significant stake in the company when you start adding those together. Now, the trend, though, is what I've been looking at in these say-on-pay packages. And increasingly, shareholders are in favor of paying the CEOs what their management is saying they should get. So if you take a look at companies in the S&P over the past 5 years, we're going to show you 3 years here, the percentage of no votes has been falling. Take a look at 2022 to 2024. Note that 2024, of course, isn't fully cooked yet. We don't have all the numbers, all the votes on 2024. But you have in 2022, 4.6% of these votes failing, or 22 is the hard number there. Then you go to 2023, 2.4% failing, 12 there. And then this year, less than 1%. And so 2 companies so far have had their shareholders say no. So a really big change here, and shareholders saying okay to these plans, all while, of course, CEO pay is on the rise. So you have some incongruent kind of initiatives there. But for Tesla shareholders, they have approximately, for their non-insiders, so the shareholders that'll be voting on this pay package for Musk, you have roughly 50% retail, roughly 50% institutional, not quite exactly. And on top of it, when you look at studies of how many retail shareholders, with Tesla having a significant number of retail shareholders here, how many actually come to the table and cast a vote? Well, it's been changing over the years. There's not a ton of data on it, but the thinking is, over the past 5 years, from those who research this area, is that, look, they can be influential and they will show up when they really care.
Even though Elon Musk had warned Tesla stock investors that 2024 won't be a good year for the company during the 2023 Q4 earnings call, this year turned out to be worse than what we expected. Tesla stock is down by nearly 30% year-to-date, thanks to a slowdown in the EV industry and the drama around Elon's compensation package, which led many retail and institutional investors to give up on Tesla stock and choose to either sell it or short it. But one major fund is refusing to turn bearish on the company and decided to go all in on the dip while selling the shares of Nvidia's main competitors in the United States, Ford and GM. In today's video, we're going to talk about this move and why it was done by one of the world's largest funds, and also why the current Tesla stock dip is a once-in-a-lifetime buying opportunity. But before we do that, if you want to keep up with Tesla's latest updates and keep up with the stock market's latest news, you can follow our Twitter account. We post multiple times daily about the biggest changes and catalysts in the market, so click the follow button if you don't want to miss the newest market updates. Now, back to today's video.
Even if it goes through, it might not help Elon Musk get his $56 billion pay package.
Yeah, absolutely. This is going to be settled in Delaware court, and I suppose possibly in Texas court, or maybe in a federal court at some point, depending on how Elon Musk responds. But what Tesla is trying to do is create, as our colleagues Dana Hull and Jeff Feely wrote, is to create a kind of way to explain this to the court. They're going to say, look, our shareholders approved it in 2018. Now they're approving it again, hopefully, as far as Elon Musk is concerned, in 2024. So it's more about forming the appeal rather than some kind of definitive resolution to this case.
It's like narrative, basically.
100%.
But the narrative with some of the, well, proxy investor groups and those advising shareholders hasn't been great. They've been saying don't go with this.
So these proxy advisors generally don't back these gigantic pay packages. They did not back the 2018 one. But what is interesting here is that you have some major shareholders coming out and saying we are against this. Over the weekend, the Norwegian Sovereign Wealth Fund said that they're going to vote against this pay package, or that as far as they're concerned right now, they're going to. Maybe there'll be some further negotiation between now and Thursday. But in any case, that fund is a major shareholder, top 10 shareholder. Norway is also a huge market for Tesla. So that seems like a significant kind of caution light for Elon Musk right now.
Recently, the Canada Pension Plan made some notable trades that all tech investors should definitely pay attention to. The fund nearly tripled an investment in iPhone maker Apple, more than doubled an investment in Chinese EV maker Nio, and doubled down on Tesla stock. Interestingly, the giant fund slashed its positions in both Ford and GM in Q1. Canada Pension Plan Investment Board, known as CPP Investments, which manages the pension, disclosed the stock trades, among others, in a form it filed with the Securities and Exchange Commission. As of the 31st of March, the fund had assets of $462.51 billion, making it one of the 10 largest public pensions in the world by assets. The pension manager bought 454,500 more Tesla shares in the first quarter to lift its stake to 979,800 shares. And although the fund refused to comment on the trades when asked by Barron's, we can definitely speculate on why it made these investment changes, especially when it comes to buying Tesla and selling legacy automakers. So, let's get right into it. Hello everyone, and welcome back to Investocracy. The global autonomous vehicle market is expected to grow at a compound annual growth rate of 32% to around $13 trillion by 2030, and many analysts expect Tesla to really benefit from this growth as long as it delivers on its FSD promises and maintains its position as a market leader when it comes to autonomy. Considering Tesla's heavy investments in AI and how advanced FSD is right now, it wouldn't be too surprising if the Canada Pension Plan doubled down on the stock with that in mind. Additionally, ARK Invest thinks that the autonomous ride-share total addressable market can reach between $11 and $12 trillion for two key reasons. The first one being the high utilization rates, as autonomous EVs can provide rides to clients 24 hours a day, only offline during charging and maintenance times. As for the second reason, we have low operation costs, as the firm expects the cost of a ride-hail to drop to $0.25 per mile, and that autonomous vehicles will reduce fuel costs up to 44% for passenger vehicles and 18% for trucks. With all of this in mind, Tesla can really benefit if it manages to dominate this market with its robotaxi service. Let's also not forget that the fund also invested in Nio, but cut positions in Ford and GM, which can be taken as a sign of the fund's bullishness on the EV market, or at least its expectations for a recovery in the EV space. This makes sense, considering the fact that both Ford and GM decided to cut down their EV production, while Tesla and Nio are two pure EV companies. If you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
And look, this has gotten so much media attention, this pay package, so I wouldn't be surprised if we see those numbers pretty sky high on this round. But that's just a prediction.
It certainly has. We've been talking about it, feels like for well over months at this point. But Alexis, I think investors out there, our viewers, are trying to figure out what exactly this means for the stock, what this means for the share price here. What did you find out?
So analysts are saying that if it's a yes, they would think that that would be supportive of the stock and the number would go up. On the other hand, a no, that it would go down. Now, that is perhaps putting into question, if it's a no, how long does Elon Musk stick around, or how much of his time does he allocate to this company given his other interests? So I'm not exactly sure what the thinking is and all of the permutations of why that is, but that's kind of the consensus out there right now.
Wedbush Securities analyst Dan Ives said in a recent note that Tesla's FSD software is the key to Tesla's future, and that Tesla's upcoming robo-taxi unveiling event is also extremely important for the company. In other words, he thinks that there's plenty to look forward to when it comes to Tesla, despite the challenging period Tesla is going through currently. He ended his note by saying that Tesla's story won't turn around overnight, so investors should be patient, and kept his outperform rating on Tesla stock. He also set a price target of $275, which implies an upside of more than 50% from current trading levels. But the majority of Wall Street analysts don't agree with Ives, as Tesla's earnings forecasts have been pegged lower and lower over the past couple of years, with Q1 2024 figures below expectations. However, forecasts show growth resuming from 2025. So, should investors buy the dip on Tesla stock? The EV market, at least in the US and Europe, has faced a number of headwinds. For example, high interest rates and inflation have played a key role in stopping ordinary consumers from buying new cars, and Tesla has felt the burn from this, reporting its first year-over-year decline in deliveries in nearly 4 years. But thanks to these headwinds, now trading at an extremely low valuation. The prospect of a PE of around 40 based on 2026 forecasts could be very tempting for investors, and if we really are at the start of Tesla's next growth phase, then Tesla stock could be considered dirt cheap right now. This was acknowledged by Morgan Stanley's Adam Jonas, who recently said that Tesla is facing the most profound realignment of priorities and strategy in the company's history, so the company is definitely in a transition phase. The key point of discussion are two catalysts that are likely to drive growth for Tesla in the coming years. First, EV adoption will continue to increase globally, and Tesla is likely to remain among the world's top 3 EV companies. Also, in the United States, no other company can compare to Tesla's position, and while Chinese automakers provide great competition globally with their very good and cheap EVs, constant tariffs and trade barriers will discourage them from coming to Tesla's home turf, securing the company's position in the country. In addition to that, Tesla is making inroads in emerging markets that would be a catalyst for deliveries growth. Recently, the EV giant talked about a new unboxed manufacturing process that can cut production cost by half. If this is achieved, Tesla's low-cost cars can storm the emerging markets. Finally, Tesla has ample financial flexibility to invest in new factories in potential locations like Indonesia and India. Therefore, this current dip is a good time to accumulate more Tesla shares. But what do you think about Tesla stock? Is it a buy at its current price? Let us know your thoughts in the comments section. And don't forget to tell us what your valuation for Tesla is. If you would like to know what companies like Tesla have been up to these past few days, go ahead and click on the next video on your screen. See you there.